Today we are going to talk about SGX. The stock has jumped a massive 30% since the Monetary Authority of Singapore announced it is reviewing ways to boost the development of Singapore's stock market. But is it time to jump on the bandwagon? Let's break it down. Currently, it seems like MAS has ruled out the participation of GIC or Temasek in these reforms. Instead, they are focusing on attracting quality companies to list in Singapore, a tougher but more sustainable approach. So it's not surprising that SGX is up on this good news. But to be honest, I think it will be quite an uphill struggle. Now, let's give credit where it's due. SGX is actually doing quite well for fixed income, currencies, and commodities. SGX has nearly 100% of the global market for iron ore derivatives. It is the largest clearing venue for dry forward freight agreement, with a market share that doubled from 35% in 2017 to 70% in 2022. And its FX futures platform hit a record 3.8 trillion in notional volume, up 43% year-on-year. And its strength is reflected in the double digits year-on-year growth for its fixed income, currencies, and commodities segment. So clearly, SGX is crushing it in these areas and has plenty of room to grow as Asia industrializes further. The part of the business where SGX struggles is really the equity cash. To be fair, it's not only SGX. There is a global trend of companies choosing to stay private or staying private for longer. There's private equity, venture capital, plenty of alternative funding that private companies can tap into without going into the public market. But where equity listing makes a poor business in Singapore is that we lack competitive advantages. Stock exchanges are platform businesses where liquidity begets more liquidity. As a result, we see globally companies tend to gravitate towards the United States exchanges where liquidity is concentrated at. It is also hard to improve liquidity on SGX by attracting foreign companies to do a primary listing in Singapore. Not just because local investors are wary after past scandals with Chinese shell companies, but it is also hard for local law enforcement to crack down on misbehavior when the company executives and assets are located overseas. The launch of Singapore Depository Receipts, SDRs, that allow local investors to trade foreign stocks on the SGX can help to mitigate some of these issues, but it still doesn't resolve the fundamental lack of liquidity on SGX. For instance, local investors will still find it cheaper to buy stocks on the respective domestic stock exchange where liquidity is better. The way forward seems to be building up our own niche, just like how Nasdaq in its early days was able to compete with New York Stock Exchange by focusing on technology companies. The SGX could also do well by developing itself as the exchange for REITs or even an up-and-coming private credit market, sort of like how CME is now synonymous for commodities. But this initiative takes time to develop, which means that the expected bump for SGX revenue might take longer to realize. And when expectations fall short, you know what happens to stock prices. So certainly the upside potential is there, but that is priced into the current value of SGX. And if you're a conservative investor, I'll say wait and watch how the MAS review unfolds. That's all for today. If you'd like to find out more, check out the link in the description below and drop your thoughts in the comments if you have any. See you in the next one.